Assalamualaikum and good morning to Dr. Jalila and my fellow classmate. My name is Alia. I'm representative from Group 1 and today we will be discussing on our case analysis. So first we'll look into the overview, then we will discuss in details on the theory and other measurements relating to the case, and lastly we will summarize our findings based on the group's discussion. So first, let's look into the overview. So prior to 2001, before the attack, previously FASB actually allows separate reporting between the profit and direct costs because revenue decline was not tied to manager performance, but external threat, which is something extraordinary. However, in 11 September 2001, during the terrorist attack, airlines company actually incurred substantial costs because the customer lost confidence in air travel. Because at that time, everyone was very scared and concerned about their own safety. So this results in decline in revenue and profits of the company. In the same year, 2001, after the attack, FASB are against separate reporting. So they demand all companies to include all costs from September 11, which have been previously omitted, to be included except for the government assistance. So the question is, why FASB is against separate reporting? Firstly, it's because it is impossible to separate operating costs and costs due to external threats. Another reason is separating costs may be unreliable because direct cost is made up of operating costs. If you look into your right side, you can see the diagram shows how direct cost is a part of operating cost. So omitting the direct cost or removing the direct cost from the operating cost might be unreliable because of the amount and also the accuracy. Another reason is because in United States, a terrorist attack is not considered as something extraordinary. So the companies will be unable to include their losses in the extraordinary item. The issues that we're able to analyze within the case study is first conflicting views between the principals. Some of the shareholders, they prefer to separate the reporting because they want to measure the manager's performance, whereas some of the shareholders, they prefer to include the reporting because they prefer to include the cost in the reporting because they wanted to know the future cash flows of the companies. And another issue is agent and principal issue, whereby managers are usually assessed based on the company's performance. However, due to external threats, there are issues in the performance measurement. So whether the company decide to separate or to include the reporting, it will definitely impact the managers. Don't worry, my friend Amira will discuss this issue in details later on. Next, we move on to principle-based and rule-based approach. So principle-based approach is actually the most popular accounting method around the globe. Basically, the company only have to adjust their accounting principles to the company's transaction rather than adjusting the company's operation to the accounting rule. So example of a system that is using principle-based is IFRS system. So actually, Malaysia is also using principle-based because our standard, Malaysian Financial Reporting Standard, is adopted from the International Financial Reporting Standard. So the IFRS have 10 principles and they also emphasize on how a company's financial statement must be understandable, readable, comparable, and relevant to the current financial transaction. As opposed to rule-based, it is much more straightforward because rule-based is a standardized process of reporting of financial statement. So actually, Financial Accounting Standard Board, the FASB, actually they adopt principle-based and they use the principle to establish accounting practices and method. So some example that is using the rule-based approach is the Generally Accepted Accounting Principle, GAAP system, which is used by the United States. So basically, the companies in United States, they need to adhere to the rules when compiling their financial statement. And failure to follow the GAAP standards may result to repercussion because they are committing accounting malpractice. So that's all from me. I will pass to Amira.
Okay, I am Amira. We'll continue with the accounting theory. The accounting theory that we have determined is positive theory. What is positive theory? Positive theory describes and explains action. For example, positive theory explains why managers adopt a particular accounting method. This will aid in comprehending the decisions of users, such as the managers, regarding accounting information, and lead to organizations making more informed judgments about how and why they present information in the way that they do. Next, Hafizah will further explain about the agency theory.
Thank you, Amira. My name is Nur Hafiza, and I will continue the presentation from now on. In the positive theories, we decided to use agency theory for this case. So, what is agency theory? Agency theory is a principle that is used to explain and resolve issues in the relationship between business principal and their agents. Basically, in agency theory, the principle delegates decision-making authority to agents. However, in agency theory, there is assumes that interests of a principal and an agent are not always in alignment. To further understand about issue of the case, first thing first, we need to know the classification of the terrorist attack. The terrorist attack is natural disaster as according to APA. Disasters from natural events such as hurricanes or earthquakes to human-caused incidents such as mass shootings or terrorist attacks are typically unexpected and overwhelming. So in this sentence, we know that it is clearly stated that the terrorist attack is a natural disaster. According to the FASB, if losses from such natural disasters meet the criteria for disclosure of unusual or infrequently occurring items of FASB AAC 225204516, they should be reported as a separate component of income from continuing operations either on the face of the statement of operations or in the notes to the financial statements. So, if the criteria of the events is fulfilled to be a natural disasters that are unusual or infrequently occurring, so it should be reported as a separate component of income from continuing operations. However, in the case, the FASB concluded that all costs resulting from September 11 be included in income from continuing operations if any government assistance reported as a separate line item. So, we propose that the company should separate all costs resulting from the terrorist attacks of the September 11, 2001 from income from continuing operations. So, the proposed solution is not comply the FASB requirement as stated in the case. So as FASB apply principle base, if there is any compliance of the standards, there is a requirement to have explanations or justifications. In the next slide, it will be explained of the whether the terrorist attack in the case is fulfill the criteria of natural disasters that are unusual or infrequently, and the link between the case and agents theory, and the reason why we propose to separate all costs from income continuing operations. So that's all from me, and I'll pass to the next presenter, Amira.
Okay, next, FASB determined that the terrorist attack did not meet the criteria for disclosure of unusual events to make it able to be reported as separate components of the income from continuing operations because the airline lost 3 days of revenue. Hence, loss of revenue is not a cost that can be included as an extraordinary item. However, the airline's manager determined otherwise, and they think that they need to separate and disclose all costs resulting from the terrorist attack in the footnote, as the separation is the best suited for evaluation of manager performance and best suited to investors founded on concerns about reliability. Based on the agency theory, as has been explained earlier, if the interests of principals are not aligned, then manager could make decisions that are not in the best of interest of principal. Hence, in this case, managers as the agent act and make decisions in the interest of the investors concerning on reliability rather than investors who primarily interest in future cash flow, because agents make decisions that coincide with their own interests. This situation portrays conflict of interest between agent and principal under the agency theory that need to be solved. The recommendations will be explained further by Alina.
Thank you, Amira. Hi, I'm Alina, and I will continue the presentation. As mentioned by Amira earlier, there's a conflict of interest under this agency theory. Even though separating the reporting of earnings is best suited for manager performance evaluations and best suited for investors founded on concerns about reliability, these events illustrate fundamental issues, as the net income solely not necessarily indicate that the firm's performance is good. Therefore, to overcome the issue and fulfill the needs of the investor, we propose to the investors to take into account other measurements to measure the firm's performance, as dependent to the net income solely is not enough. As the investors, they should also look at to the performance of asset and capital, as well as this will help them to understand the firm well and can help them to determine how well a company is performing over time and how it sticks out with industry peers, especially during pre- and post-terrorist attacks. Among the measurements are return on investment ratio, return on assets ratio, return on equity ratio, earning per share ratio, price to earning ratio, and cost benefit analysis. So let's move on and know about this ratio. Return on investment, or we also call as ROI. ROI is a performance measure used to evaluate the efficiency of or profitability of an investment. In other words, it measures the total return that the company has provided for its investor. The higher the ROI, the better, as the higher ROI percentage indicates that the investor gains of a project are favorable to their costs. So the investors can take ROI and compare it with the previous performance of the company, which is before the terrorist attack and after the terrorist attack. Second is return on asset. Return on asset is an indicator of how profitable a company is relative to its total assets. ROA gives a manager, investors, or analysts an idea as to how efficient a company's management is at using its asset to generate earnings. The higher the ROA, the better, as it indicates the company is doing a good job of increasing its profit with each investment dollar is spent. Investors can use ROA when comparing similar companies or by comparing a company to its own previous performance, which is, for example, during pre- and post-terrorist attack. Next is return on equity, or also known as ROE. ROE is a profitability ratio that measures the ability of firm to generate profits from its shareholders' investment in the company. Same with others, the higher the ROE, the better, as it indicates that the company is using the investors' fund effectively. By using ROE, an investors could take that number and use it to help examine how the company stacks up against its industry peers, especially during the post-terrorist attack. Okay, so next, I will pass to Izzati to continue the presentation.
Thank you, Alina. Okay, I'm Nur Izzati Ilani, and I will continue on the next measurement of the company's performance. Okay, so earning per share is a profitability ratio used to estimate the corporate value by measuring the portion of corporation profit allocated to each outstanding share of common stock. So a higher EPS indicates a greater value for the corporate, and a continued EPS growth provides a sign that the company is able to sustain profits over time. So rather than focusing on the net income solely, the investors who are interested primarily in the future cash flow may compare the current EPS across similar companies within the same industry, while also looking at the historical trends in order to make a more informed and prudent investment decision. So if one company consistently outperforms the others or shows steady track record of reporting increasing EPS ratios year over year, it shows that the airline company is stable and its stock price is likely to continue increasing, and a stable company are more likely to recover the loss from the disasters. For the next measurement, which is the price to earning ratio, it indicates the relationship between a company's stock price and its EPS. And just like the previous ratio, it can be used for comparative analysis with other companies or industry benchmark to give investors a better sense of the value for the company. Hence, it helps determine whether a stock is undervalued or overvalued. So in general, a high PE ratio suggests that investors are expecting a higher earning growth in the future compared to companies with lower PE ratio. However, it may also indicates that the stock is overvalued, and vice versa. A low PE ratio can indicate either that a company may currently be undervalued or that the company is doing exceptionally well relative to its past trend. Hence, investors who are interested in future cash flow should make comparison across company within the same industry in order to have a framework for determining the better value for the ratio. Okay, so the last measurement that can be used to evaluate the firm performance is by using the cost-benefit analysis. So cost-benefit analysis is the process used to analyze decision, system, or project by measuring its benefit minus the cost associated with taking that action. So if the benefits outweigh the costs, the investors may proceed with their investment. And by using this analysis, it helps the investors to outline every potential cost and benefit associated with the company. Hence, although we suggest separating the cost of these catastrophic events from the net income, but the investors who are interested primarily in future cash flow can include the costs that could be found in the separate section of earning in the cost-benefit analysis in order to predict the future cash flow of the company. Okay, so to conclude, due to these catastrophic events, we suggest the airline company to separate the costs resulting from the terrorist attacks from their earning, as it is more suited for evaluating manager performance when the disaster happened and for the investors who founded on concern about the reliability of the report. So this decision is made based on positive and agency theory, where the theory assumed that as the interests of principal and agency are not always in alignment, and it is impossible to maximize the interests of all stakeholders simultaneously. Hence, managers will make the best decision that will coincide with their own interests. So, however, as the decision does not coincide with the interests of investors who are interested primarily in the future cash flow of the company, we have suggested 6 other measurements to evaluate the company's health and performance without solely basing on the net income of the company. Next, this is the reference that we use in our presentation. That's all from us. Thank you for your attention.